Hey there, future retirees and savvy investors. Kyle Hammerschmidt here from Mocan Wealth Management. Today, we're diving into a topic that's crucial for your financial future, but it's really often misunderstood. Why risk tolerance alone shouldn't be the driving force behind your investment decisions. You might be thinking, Kyle, I've heard risk tolerance is important. What gives? Well, you're not wrong, but there's often so much more to the story. In fact, I've got 5 compelling reasons why relying solely on risk tolerance could be holding you back from achieving your retirement goals. In this video, we're going to explore the crucial difference between the risk tolerance and risk capacity, why your time horizon matters more than you might think, why taking a holistic financial approach trumps simple risk assessments, the pitfalls of standard risk questionnaires, and why education is the key to better investment decisions. So grab a cup of coffee, settle in, let's uncover the crucial aspect of retirement planning together. Trust me, by the end of this video, you'll have a whole new perspective on how to approach risk in your investment portfolio.
This is Retire Ready, where we break down retirement planning and make it easy to understand. Planning your retirement starts now with your host, Kyle Hammerschmidt.
Reason 1, risk tolerance is emotional, risk capacity is rational. Again, I just want to kick things off first and understanding what's the difference between risk tolerance and risk capacity. Risk tolerance is essential. It's basically how much you can stomach in market ups and downs. It's the feeling in your gut when you see your portfolio drop 10% in 1 week. Some of you might shrug it off, while others might lose sleep over it. Risk tolerance is deeply personal and emotional. On the other hand, risk capacity is about how much risk you can afford to take based upon your financial situation and your goals. It's a rational, numbers-based assessment. So let me kind of give you a real-world example. I had a client once, let's call him Bob. Bob came to me saying, hey, I have a very low risk tolerance. He wanted to keep most of his money in safe investments like bonds and cash. But here's the thing, Bob was 55 years old, had a stable job, was planning to retire at 65. When we crunched the numbers, we realized that with his current savings rate and conservative investment strategy, he actually falls short of his retirement goals by a significant margin. This is where understanding risk capacity comes in, because despite Bob's low risk tolerance, his risk capacity was actually much higher. He had 10 years until retirement, a steady income, and the ability to weather short-term market volatility for long-term gains. Here's another example. Let's say meet Linda. She's 60 years old and planning to retire at 65. When Linda filled out a risk questionnaire, she indicated she was moderate. She gets nervous when the market dips and prefers stable investments, like most people. But here's the thing, Linda's risk tolerance doesn't tell the whole story. We need to look at her risk capacity. Linda has a stable job, no debt, and has been a very good saver. She's on track to have over $1 million saved by retirement. She has a pension, Social Security, and that will cover 60% of her expected expenses. This means that Linda actually has a higher risk capacity than she thinks. Within only 5 years until retirement, time horizon is very short. However, remember, retirement isn't a finish line. It's the start of a new 20 to 30-year journey. She needs to keep in mind she needs this money to last throughout her retirement. So given Linda's strong financial position and the need for long-term growth, her risk capacity actually suggests she could benefit from a more balanced portfolio, even if it makes her a bit uncomfortable in the short term. So what's the key takeaway? Why Linda's risk tolerance says play it safe, her risk capacity says she has more room for growth. Again, we help clients like Linda and Bob understand the crucial differences and build retirement strategies that align with their true financial situation, not just their comfort level. Remember, successful retirement planning isn't about avoiding all risks. It's about managing the right risks for your unique situation. Don't let fear hold you back from reaching your retirement goals. Your gut feeling about risk is important, but it shouldn't be the only factor driving your investment decisions. Understanding your risk capacity is crucial for a successful retirement strategy. Next is really the time horizon. So time horizon matters more than you think. The reason why we focus on this critical factor is it's often overlooked. So your time horizon is simply how long you have until you need your money and how long this money needs to last. So here's the kicker. The longer your time horizon, the more risk you can potentially handle inside of your portfolio. So let's go back to Bob. He was within 10 years until retirement. He had an advantage. Why? Because over long periods, the stock market has historically trended upwards despite short-term volatility. We explained to Bob that with a 10-year time horizon, he had the ability to ride out market downturns and potentially benefit from long-term market growth. This doesn't mean we recommend an overly aggressive strategy, but it did mean we could consider a more balanced approach heavy on equities that aligned with his true risk capacity. And then if we go back to Linda, remember Linda's situation, she's 60, planning to retire at 65. But something crucial to remember, her investment journey does not end at retirement. At 65, you could easily have another 20 to 30 years ahead of you. That's a significant amount of time for your money to grow, and it needs to work for you. While it's natural to feel cautious as retirement approaches, we still need to balance that. In reality, you still have long-term needs. Inflation is like a silent tax on your savings. To maintain your purchasing power over 20 to 30 years during retirement, your money needs to grow. This means we can't be too conservative with your investments. So we took a balanced approach to basically that could help your nest egg provide growth potential you'll need throughout retirement. We're not talking about taking unnecessary risks, but rather strategically positioning your portfolio to address both short-term comfort and long-term needs. Remember, Linda, retirement is not the finish line. So I think a lot of people lose focus on that. It's just the beginning of a new phase. So creating a strategy that serves you well, not just for the next 5 years, but for decades beyond. In contrast with someone who's just a year or two away from retirement, their time horizon is much shorter, which typically means they have less capacity to take on risk, regardless of what their personal risk tolerance is. Basically, the key here is what your time horizon should play a role in your strategy, often more than emotional risk tolerance. Next is just taking a holistic financial approach over just risk assessments. And why you would do that is looking at the big picture. A holistic financial approach is far more effective than relying on a simple risk assessment. When it comes to retirement planning, your investment strategy doesn't exist in a vacuum. It's part of an overall financial life, which includes your spending strategy, your tax situation, your Social Security benefits, and much more. So let me share you a story from a client, and I'm going to call her Sarah. Sarah came to me worried about market volatility and investments, was very conservative. Basically, we discovered some interesting facts that she was ultra conservative within her investments. Her spending habits were actually quite frugal, which meant she needed less income in retirement than she initially thought. By optimizing her Social Security claiming strategy, we could actually reduce the pressure on her investment portfolio to generate income in her early years of retirement. We identified opportunities for tax-efficient investing that could improve her after-tax returns without taking on additional market risk. So the key here is by an individual taking a holistic approach, you can design an investment strategy that will meet your needs without being overly conservative. This strategy aligned with Sarah with her true risk capacity. And what was like the lesson to take away is like a simple risk assessment shouldn't dictate your entire investment strategy. Your financial life is complex. Your retirement plan should reflect the complexity. I personally believe in like taking a whole picture approach because you need more than just a diversified pie chart and like a Social Security check. That's a great way to like lose sleep at night. Number 4 is like just like the standard risk questionnaires themselves. The reason why I focus on this is there's tools out there that you've encountered, and that's like the standard risk tolerance questionnaire, like the type of questions. It asks you a series of multiple choice questions. How would you feel if your portfolio dropped by X%, or what would you do in various hypothetical market situations? While these questionnaires can provide some insights, I personally believe they have some significant limitations. First, these questionnaires often fail to capture the nuances of your financial situation. They don't consider your income and expenses and taxes and other assets you might have. What type of spending strategies are you going to use in retirement? They typically focus on short-term reactions to like market movements, which may not align with your long-term financial goals. Third, your answers could be heavily influenced by like recent market performance or like your current emotional state, leading to responses that don't accurately reflect your true capacity. Let me give you an example. So let's take Tom. Tom filled out the risk questionnaire during a bull market. His responses indicated he was comfortable with a high-risk portfolio. But when we dug deeper, we realized that Tom was nearing retirement, had a moderate income need, and actually couldn't afford to take on that much more risk than he had now. On the flip side, I've had clients who've answered risk questionnaires resulted in a very conservative approach, but whose financial situations actually allowed for and required a more balanced portfolio to meet their long-term goals. So like at Mocan Wealth, we use risk questionnaires as a starting point just for discussion, not as the final word on investment strategy. I believe in having in-depth conversations about your financial life and goals and concerns to basically develop a personalized approach to your risk management. And then reason number 5 is education. So the final reason is perhaps the most important is really education approach is the key to better investment decisions. Often when I meet with people, they say they have a low risk tolerance or moderate, and they don't really know what that means and how it applies to their investments and how that's going to work in retirement. And that's okay. The world of finance can be complex and intimidating. But here's the thing. Knowledge is power, especially when it comes to investing. So I'm going to share a quick story. I had a client, Tom. He was 58. He was going to retire in 4 years. He came to be convinced he needed to move all of his investments to safe investments like bonds and cash and CDs. Why? Because he heard the stocks were too risky for someone in his age group or approaching retirement. Here's where education made all the difference. We sat down, went through some key concepts. We first looked at inflation. Tom didn't realize that playing it too safe could actually be risky. We calculated how inflation could erode his purchasing power over like 25 to 30 years in retirement if his money didn't grow enough. Next, we looked at like what does diversification look like? It's not about avoiding stocks entirely, but about finding the right balance for his specific situation. We also explored the concept of sequence of returns risk, how the timing of the market downturns can impact your retirement portfolio. This helped Tom understand why he needed a strategy that wasn't just like a safe approach. Finally, we looked at historical market data. Tom was surprised to learn about the long-term performance of different asset classes, which really helped put short-term market volatility into perspective. As Tom was like understanding, he grew basically amazed at what could happen. His confidence grew. He started to basically see his retirement savings not as a scary unknown, but as a tool he could strategically use to support his retirement dreams and goals. Like, what's the result of this? Like, take a more balanced retirement strategy approach. Tom felt good about that, but you want to aim to provide both growth he needed, but also the security he was wanting. Trying to find that balancing act. Here's the bottom line, folks. As you approach retirement, like, don't shy away from like financial education. Understanding concepts like inflation, diversification, market behavior can basically help you make more informed decisions. But it can also be the difference between a retirement strategy based on fear and one based on knowledge. That's huge. I believe in empowering our clients through education, because when you understand your financial strategy, you're more likely to stick with it through market ups and downs, and that consistency is key to long-term success. Remember, it's your retirement. Like, the more you understand, the more control you'll have over your financial future. So keep learning, ask questions, create a retirement strategy that you can feel confident about.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon.